In this video, I'm going to show you exactly how I trade the wheel strategy using options on Robinhood to collect monthly premiums. In fact, last month in July, I collected over $60,000 in premiums, and I'm going to show you exactly how I did it step by step. Now, let's go ahead and jump into it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes. Only results may vary, but let's go ahead and jump into the portfolio. This is the live portfolio I show here on YouTube. So if you want to see me hit my 8-figure goal and you want to follow along on that journey, please subscribe down below by clicking the subscribe button. Also, if you get any value out of this video whatsoever, please hit the thumbs up button for me, as I greatly appreciate it. So as you can see right here, we're going to go into the realized gain loss, and I'm going to show you for educational purposes what happened in July. So we're going to go to July 2025, right? And I do these every month. I show my progress reports. But let's go ahead and go press search. And as you can see, $60K in premiums with 0 losses. And this excludes capital contributions. So this was pure profits for me. Obviously, results vary month to month, but this was a 5.7% ROI for me on the portfolio, utilizing the wheel strategy with options. So I'm going to show you exactly how to do it step by step in this video. Before we jump into it, if you do want to work more closely with me one-on-one and you want to join my mastermind of 280 high-level investors and traders, that's going to be at the top of the description. If you go there, you're going to see this free training here. You could watch some of my client testimonials that I upload every week, and you could book a call with me or one of my team members. Also, I give away free trade ideas here on my Instagrams and my free newsletter, which are both down in the description below. So make sure to be subscribed to both of those as well to get my latest free trade ideas. But let's go ahead and jump into it. The wheel strategy. The 3 criteria I utilize to make sure that I'm collecting monthly premiums every month and I'm not going to ever lose on this particular strategy, okay? Because there's a lot of people out there that talk the wheel strategy, and the big concern is, hey, well, what happens if the stock keeps going down? Well, the stocks that I choose, they always rebound when there's a stock market crash or recession, because they're blue chip companies and they have good charts and good earnings. And I'm going to show you exactly how I find these companies as a high level investor. I'm going to show you exactly how you could do that. And I'm going to show you why Robinhood meets those criteria. So the wheel strategy. Quick overview, then we'll dive into the nitty-gritty of it. But if you don't know what it is, basically we are selling puts, we are selling stock insurance. Think of it like selling, insurance for investors who, if the stock wants to go, if it goes down and they want to get out of the stock, right, then they're able to do so, but they have to pay a premium, okay? So just like car insurance, we don't ever expect to get in a car accident, right? But we have the insurance just in case, and we pay that premium every month, and by the throughout our lifetime, we probably paid more premiums than the car was actually worth, okay? So that's exactly what I do. I sell puts on blue chip companies, and if the stock goes down, I get to buy the stock at a discount, and then I sell covered calls against my shares, right? And then eventually my shares get called away because the stock goes above my call price, so I have to sell my shares at a profit, and I got a premium, and then I do it all over again, okay? So I collect premiums every single month, and sometimes I get assigned those shares, and then I collect appreciation and premium, which is a double win. So that's exactly how it works. We sell puts every single month, and then finally the stock tanks. We get assigned the shares, sell calls. Eventually the stock rebounds back up, and then we have to sell our shares, and we do it all over again. So the first criteria is the stock must have a great chart. So it must be upward trending in the past year and a half. And I'm going to show you the Robinhood chart, okay? So this is the Robinhood chart. If we go back a year and a half, right, we go back to 2024, all right, you could see that this stock has clearly been uptrending. That is exactly what we want to see. We want to see stocks that have a nice, clean uptrend, because this is a neutral to bullish strategy. It's much easier to trade this strategy when the stock is, trending nicely upwards, okay, versus let's just go to a competitor stock, okay? We're going to go to a competitor stock like Webull, all right? A lot of people are talking about that one. And you could see that this stock, since they IPO'd beginning of the year, has just been trending downwards. This is not the type of stock you want to trade with the wheel strategy because it might go against you, all right? So the chart has to look beautiful, and Robinhood meets that criteria, all right? So Robinhood has a beautiful chart, meets the criteria, and it's very easy to trade the wheel strategy on. So most of the times when people lose on the wheel strategy, it's because they selected a stock that has a negative downward trending chart for the past year and a half or longer. And that's just not gonna work for the wheel strategy. So that's the first criteria. And that might be the most important criteria because a stock, the company may be doing well, but the stock chart may not reflect that company, right? So, that happens to companies sometimes and it sucks, but we just stay away from those companies. So a great chart is gonna be number one. Number two, great valuation. So the stock must have a PE ratio of ideally 100 or less, especially if it's a growth company. The PE is gonna be a little bit higher, which is the price to earnings ratio, how much they actually earn per share of their stock, right? The higher the PE ratio, the more overvalued the stock. We wanna find those companies that are not too rich in valuations, okay? Obviously, the average for the S&P 500 right now, I believe, is between 26 and 27 PE ratio. So the stocks that we trade are definitely going to have a PE ratio that's higher than the average S&P 500 PE because they're growth companies, okay? Now, if the PE is really high, it's over 100, then they better have enough cash on hand to cover their debts. So we're going to take a look at Robinhood. I'm here on tradingview.com. This is just one simple tool that I use and I actually pay for. But I like it because if I scroll down, I could see, I could see their PE is 52. So not super high, but not, extremely low. It's a growth company. So that's good. It's under 100. And then I like to go down to their cash and, their net margin. So as you can see, their net margin for this most recent quarter was a 38% profit margin. That's great. They're earning money. They're profitable. They have good profit margins. That's what I want to see, okay? So they meet that criteria, but how do I further investigate? Okay, PE is the easiest way to kind of see if this company is overvalued or undervalued or way too expensive. And we're looking at that. But how do I make sure that this company is going to continue to go upwards in the future? Well, I like to deep dive a little bit further, and I'm going to do some analysis. I'm going to show you kind of behind the scenes how exactly I do it, right? And this is what I show to my clients in Options Trading University. But I like to look at their investor relations booklet. Okay, this was their last earnings presentation that came out just a week ago. And I like to see that, hey, is the company coming out with new products? Are they growing their customer base, right? And are they charging, a recurring revenue type business, right? And Robinhood has Robinhood Gold, which is recurring revenue for them. They also, make money on the back end. So I like to see, okay, is their customer base growing? Well, their Robinhood Gold subscribers adoption rate grew 13% this past quarter. So they are growing their Robinhood Gold subscribers that pay $5 to $10 a month. As you can see, 3.48 million subscribers, and this is growing every single quarter. A year ago, they grew at 8.2%. Now they have a 13% adoption rate. So out of all the new people that utilize Robinhood and deposit funds, 13% of them are adopting Robinhood Gold and paying for that. So that's a lot of revenue there. As you could just do the math, right? It's about $16 million in recurring revenue per month, okay? Another thing I like to see is what are they coming out with in the future? And I love how they do this timeline, right? They're coming out with crypto staking, so that's gonna bring in a lot of new customers that potentially want to stake their crypto to earn a yield, an ROI, right? A monthly cash flow from just staking their crypto on the platform. And they're also introducing their own blockchain, which is huge. So this is a huge one. Another one is they're releasing in the EU stock tokens. So tokenized stocks to where people all around the world can, as long as they have a Robinhood subscription, they have a brokerage platform with Robinhood, they can invest in US equities via stock tokens. So that's huge. This is giving access to US equities to the whole world if they have a Robinhood account. So that's what I like to see. Obviously new products. They also have this gold card that they are trying to make more robust by giving 3 to 5% cash back. And they're obviously trying to make this a more attractive card to use. So this is another thing they're growing, right? And then obviously the staking and earn rewards on Robinhood for staking your crypto. So they're growing the customer base. The gold subscription is growing, higher adoption rate. People see the benefits of just paying $5 a month for the Robinhood Gold. And they're getting into the banking sector, so that's huge as well, right? They're doing their Robinhood banking rollout, gold card expansion, right? And a lot of new stuff. So this is exactly what I want to see on a company. More customers equals more revenue and profits overall, okay? Now, the last thing, great premiums. Does the company have liquid options that we could trade, and are they paying out anywhere from 2 to 5% per month on on a monthly option, on a monthly put option? So that's what we're going to dive into. All right. First, before we get into that, I want to talk about VIX cash allocation levels, because this is going to be very important since you now are managing your money, you're managing a portfolio. You need to know how to efficiently allocate capital. You don't want to be 100% invested when the market's at all-time highs, because like traditional investors say, oh, just, dollar cost average, always be invested. That doesn't work with options trading. We want to make sure that we have enough cash to take advantage of high volatility, meaning when the market tanks, okay, when the market rolls over and goes down, put options get more expensive, meaning we get to sell more expensive put options. So a typical option that would pay out 2 to 3%, let's just say on Robinhood, when the market tanks, those same put options will pay out 5 to 7%, okay? So we want to be able to have cash to take advantage of those opportunities. So I'm going to show you where we're at. The VIX levels right now we're actually above 20. So this means there's a lot of fear in the market. The market just tanked recently, yesterday. And essentially, I could be 80 to 100% allocated or have 0 to 20% of cash on the sidelines. And that's exactly where I'm at. I have about 15% of cash on the sidelines because VIX is at 20 to 30. So I pretty much went all in, right? I'm very heavily invested. So if we look at the VIX, you could see that we spiked up a bit, okay? We spiked up above this 20 level, which means there's a lot of fear in the market, okay? When we had this last crash, I'm going to look at QQQ, right? When we had this 5th fastest stock market crash here in April of 2025, right? You could see that at the peak, at the bottom of this crash, the VIX was at the highest. It went to 60, which we've only seen a few times, or actually a couple times in the past 5 years, okay? So the last time we saw that was the year before in August of 2024 when we had the Japanese yen carry trade crash. And then the last time, we didn't even see it during the bear market. We saw it during the COVID crash of 2020. So a VIX being above 50 is an indicator that I need to go all in, right? And I did. I actually transferred 100K into the account on this day, and that ended up being the best decision because on that day, right, we hit the bottom and then we rallied quite a bit. Okay, that's when President Trump called off the tariffs or put a pause on the tariffs on China, and we started rallying, and that money that I put in multiplied a lot. So you want to be aware of this. If you need a screenshot, right? Obviously, when VIX is 10 to 12, I'm like 80% of cash on the sidelines and only 20% invested. But this is very rare that we have the VIX that low when the market is super greedy and at all-time highs, okay? So screenshot this, and let's move into the options, okay? So wheel strategy on Robinhood. Let's talk about cash secured puts. How does this work? Well, how it works is, let's just say the stock is trading at $100, right? And I think it's trading at 99. So this is a good example. Stock is trading at $100, okay? We could sell a put option right here at $90 and collect, let's just say $500. This option expires in 30 days. So as long as the stock doesn't go below 90, we get to keep that $500 and we get to do it all over again, okay? We do it the next month. Same thing. Stock's trading at 93. We sell the 90 put option and the stock ends up at 97 by expiration. We keep another $500, right? Now, what happens on the third month if stock's trading at 97, we sell the 90 put option, and then the stock by expiration goes to 85? We are forced to buy 100 shares of the stock. Now I have to buy 100 shares of the stock, but I got paid that $500 premium. I get to keep that. So I got paid to dollar cost average, right? And that's how we make money on the put side. We sell puts, collect premium, and then eventually we get assigned the shares at a discount. So we got paid to dollar cost average, right? So what I like to do is sell the 20 to 30 delta cash secured put. And what that means is 20 delta means it has an 80% chance of expiring worthless and a 20% chance of getting assigned. And 30 delta, it has a 30% chance of getting assigned. So the difference is I'm going to get paid more the higher the delta. The higher chance it has to get assigned, I'm going to get paid more because I'm taking on more risk, all right? So I do 20 to 30 delta typically. I go out 30 days to expiration for monthly income, and I enter on a red day so I could get a little bit further away from the stock. And let's go ahead and dive into the portfolio, and I'll show you exactly how I do it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. But let's take a look at the portfolio. As you can see, I have quite a bit. Actually, I have more cash than I thought because some of my shares got called away, collected some premium there. So we have this Robinhood position, okay? I have 141K in cash secured puts. This is my largest position to collect 5K in premium for the month of August, okay? Now, if I go here, I'm gonna show you exactly where I would go. So I'd go to the options chain. I'd go out, let's just go to the end of August, 27 days out. Typically I'd go out 30 days, but we could go out 27, that's fine, okay? And I would go to the 30 delta. So there is no 30 delta, there's a 29 delta, there's a 31 delta. Let's just go to the, we're gonna go to the 29 delta to be safe, okay? Now, the ROI there is a 3.9% ROI, okay, in 27 days. Now, results aren't guaranteed. These numbers fluctuate by the time you're seeing this, but this is for example purposes, okay? So if I sell the 92 strike, I will collect $3.45 times 100, so $345, all right, to sell this option, okay? Obviously, these numbers fluctuate. But I'll collect that, okay? I'll sell that, so I'll click on that. Sell August 29th, 92 put option. And usually I try to hit this mid price so I can collect 350, kind of right in the middle. And I'll review and send, and boom, I'll get filled on that and collect my 3.9% ROI, okay? So that is that, and I do that every single month, right? And obviously, if you wanted to get more safe, you wanted to get further down, you could go to the 90 strike. That's a 25 delta, right? You could go even further down. You could go to the 20 delta, which is the 87 strike, but you'd collect less. So you'd collect 2.5%. I would collect 2.5% ROI. Results vary. But let me just show you how that looks on the chart, okay? So we're gonna go to Robinhood. And like I said, the stock's trading all the way up here. But if I went to that 20 delta, that would be the 87 strike. So I'd get all the way down here. So I'd collect 2.5%, and I'd be pretty far away from the stock. If the stock did go all the way down there, right, that's a 12% discount from current prices, and from all-time highs, right, that's a 22% discount on the stock. If it did go down there by expiration, I'd have to buy the shares, okay? But that's fine. As you can see, I got paid to get a 22% discount on the stock, okay? My current ones are very close to the stock. They're at the 94 strike, so that's about right here. So if I do get assigned from all-time highs to where, assignment would be, that'd be about a 17% discount on the stock. So still not bad, and that's why I went for that strike, okay? So that's exactly how the puts work. You basically, as long as the stock stays, above your strike price, it stays above this line, you don't have to purchase the shares, and you could do it all over again, okay? Now, let's talk about what happens if by expiration, okay, the stock just tanked down and it went to 80, 85, I don't know, 83. It had bad earnings or some news came out and now it's down here. Well, now you have the shares. You're going to buy the shares. They're going to assign you 100 shares of Robinhood. And now to generate or collect premium, we have to sell covered calls. Okay, so let's talk about covered calls. I like to sell the 30 delta. Sometimes I go 40 delta for more premium. That's fine. 30 is just kind of a typical average. And I'll go typically 15 to 25 days out for bi-weekly income or every 3-week income, okay? Enter on green days, and these you could just set it and forget it. I usually wait until expiration to let the shares get called away, and then I'll free up that cash. Or I'll enter a new covered call position if the stock doesn't go past my calls. So again, stock's trading at 100. Let's just say we got assigned at, let's do this. The stock is trading at 100 at X, okay? We got assigned today, let's just say at 100, all right? We're gonna sell the 110 covered call. As long as the stock doesn't go past 110, we don't have to sell our shares. We get to keep the premium from that covered call, and we do it all over again, right? Let's just say next month the stock goes to 115. Well, we're gonna have to sell our shares at 110. So we made 10 bucks on our share appreciation plus the covered call premium. And now we have a bunch of cash ready to go for a cash secured put. But let's go ahead and dive into it. This is exactly what I do. So let's go out 20 days. I'll go out 20 days. Let's just say we got assigned today at 99. All right. What I'll do is I will go ahead and sell. Let's just sell the 40 delta. I like to go super aggressive for more income, right? If we go to the 40 delta, that's going to be the 105 strike. So essentially, if I had to sell my shares, if the stock went to 110, I'd have to sell at 105. Okay, I made $5, right? From 99 to 105, that's about let's just say 5% return on the share appreciation. Plus, I collected another 4% on the premium. So I made 9% if the stock goes above 105 because I have to sell my stock at a profit, and I get to keep this premium, okay? So there's a lot of premium here. That's typically why I go a little bit more aggressive on the covered calls so I can collect good premium and get share appreciation. I make more money on the covered call side, okay? So that's typically what I would do, all right? So I'd do the 40 delta. Now, if you want more, you want the most appreciation, you go to the 30 delta. So you go to the 110 strike, which is funny that was my example. Okay, that's about a 30 delta. And I'd pick up 2.5%, right? I'd pick up 2.5% on the premium to $255. Obviously, results vary and aren't guaranteed because these numbers fluctuate. But let's just say I sold this one against my shares today, and the stock goes to 115. I'd sell my shares at 110, so I'd pick up 10% of appreciation on my shares plus an additional 2.5%. That's a 12.5% return on those covered calls. But the chances of getting called away are slimmer, right? 29% chance versus a 40% chance of getting called away, okay, based off the deltas. So that's typically how I run the covered calls, all right? So I'm collecting premium on the puts, collecting premium on the covered calls. Now, how do I increase returns? Well, there is a strategy that's not part of the wheel. This is kind of part of my tailored wheel strategy, is I sprinkle in what's called a LEAPS call option. Now, what a LEAPS is, it's a long equity anticipation security. This is a call option that expires in 365 days or more. Okay, so I typically go out 500 days just to give myself enough time to be right. But I'm gonna show you exactly what I do. So right now, Hood is trading at this, and we'll click this, and let me get rid of this so you can see what I'm talking about here. So as you can see, what is called, these two lines right here are called Bollinger Bands, all right? I have these Bollinger Bands pulled up because 95% of the time, the stock is gonna stay in between these two Bollinger Bands. 5% of the time, it's gonna breach above the Bollinger Bands, and when it does, or below, when it does, right, like here, it sucks back in, okay? The price reverts back to the mean or average price. So this is a statistical indicator, And right now, the stock is trading near the lower Bollinger Band, okay? So typically what I would do if Robinhood goes below this middle Bollinger Band line, and I did it actually on Friday, but we got out of them, is I'll buy a Leaps call option. So what I'll do is I'll go to the options chain. I'll go out, let's just say to January 2027, 531 days out, and I will buy the 70 delta option. So as you can see, this is a 71 delta, 90 strike, call option. It's going to cost me about 3,600 bucks, okay, to control 100 shares. Now, if I bought 100 shares today, that would cost me 9,900. So I get to control 100 shares for 3 times less of cost. But there is a component here of theta decay, okay? So these call options have what is called theta decay, or they lose value every day that goes by. And this option right here is losing about $2.77 per day. So the stock must go up for me to make money, okay? And preferably fast, okay? Now, most people trade options like 30 days out, okay? And they'll trade that same 70 delta option, okay? Let's just say, yeah, right here, the 91 strike 70 delta, but this option's decaying $11 per day. Okay, so the further you go out, the slower the theta decay, and that's why I go out so far in time, okay? Gives me enough time to be right, because if I'm wrong, I have time on my side for the stock to go back up and make money, all right? So that's exactly how I do it. I'll, get one of these, and when Robinhood bounces back up to this upper Bollinger Band, like there, I will exit. I'll exit. And most of the time, I'm making anywhere from 15 to 40% ROI on these leaps, and in a short amount of time. Okay, obviously results vary month to month, but that's how I kind of boost the returns by doing these every once in a while when the stock kind of crosses this middle Bollinger Band line. Obviously, you see Robinhood hasn't done this in a very long time, and that's why I got into them on Friday, because it did. Sometimes it takes 3 months for this stock to kind of breach below the lower Bollinger Band. It's rare if I draw it, okay? One time there, like throughout this whole year. One time there, one time here. Okay, this is the third time. This is the fourth time. And then fifth time, middle Bollinger Band, right? And then this 6th time. So 6 times within a year so far, okay, that you had the opportunity. So it's very rare, but the opportunity comes, and that's kind of how I boost the returns on these. Now, if you enjoyed this video and you want to watch another one on another stock that I trade the wheel on, I'm going to link that right there, okay? Watch that one. Please hit the thumbs up, and I'll see you in the next video. Take care.